Come play with us, Danny. Forever and ever and ever.
All right. Today is Wednesday, August 18th. This is a recap for the stock market activities today. The market continues to whipsaw up and down with extreme movements. It's a battle between the dip buyers, human beings and algos alike, versus the reality of the wall of worry. Specifically tapering. When it comes to tapering, it's a battle. Is the Fed bluffing about tapering? Or are they serious about tapering in September? Or at least the announcement of tapering in September? There are two camps here, waiting in the facts, and we will go over them because it is important to know which camp is winning for now. This will determine the destination of the stock market in the next few days. Will the dip buyers win, or will the dip buyers get slaughtered? And therefore, in focus tonight, we start with the wall of worry once again. And we will talk about tapering first, because it is the imminent concern for now for the market, specifically after the release of the FOMC minutes. But first, let's go after some definitions here, some facts from the Fed chairman himself, Jerome Powell. Fact number one, what is the definition of transitory? Let's hear it.
It is that the increases will happen. We're not saying they will reverse. That's not what transitory means. It means that the increases in prices will happen, so there will be inflation, but that the process of inflation will stop, so that there won't be further. When we think of inflation, we really think of inflation going up year upon year upon year upon year. That's inflation. When you have inflation for 12 months or whatever it may be, I'm just taking an example, I'm not making an estimate, then you have a price increase, but you don't have an inflation process. And so part of that just is that if it doesn't affect longer-term inflation expectations, then it's very likely not to affect the process of inflation going forward.
Okay, so Powell says the definition of transitory is prices will not go down. The price increases you see around you, these will stick. They will not go down, but the pace of increase will slow down. Therefore, inflation is transitory. You and I know that this is bullshit. Absolute bullshit. It doesn't mean anything at all. And it is a dangerous assumption by Powell, a reckless policy which could result in a disaster. And you will see the disaster happening anyways in the next few weeks, specifically in the fourth quarter of this year. This is the nominal wage growth going back all the way to 2007. On average, wages grow anywhere between 1 to 3% year over year. Let's say on average 2%. We're not using any calculators here. We're not going to overwork our little brains because the Fed isn't either. The Fed says we're not guided by any formula in adjusting inflation to 2% on average. We're just going to eyeball inflation. Therefore, we're going to eyeball stuff here for simplicity. So wages grow on about 2% average year over year. Now we have this inflation, the unique conditions of the pandemic, etc. So our wages grew about 4% year over year. But mind you, the growth of wages is still at an average of about 2 to 3% when you compare it to the pre-pandemic levels. So keep that in mind, but we will use the 4% number for illustration purposes. Now, here is the growth in home prices year over year. Now, housing, whether it is mortgage or rent, is the biggest expense for any average American household. The growth in home prices, on average, is about 5% year over year. But now we have the unique conditions of the pandemic and the inflation, and therefore, home prices are growing by about 12% year over year. So we'll keep these numbers in mind. The result of the gap of growth between wages and housing prices is clearly illustrated in the Case-Shiller Home Price Index growth versus the median annual income. Income income in black, the Case-Shiller Index in red. There was a time, believe it or not, in America where housing was actually affordable. But as the Federal Reserve got engaged in engineering the economy rather than being the plumber, watching the plumbing, making sure that the plumbing in the financial system is going on accordingly, and only intervening when the plumbing needs to be repaired, maintained, or if there is a problem. This is how the Federal Reserve has been operating for years. But after the Greenspan era, the Fed got engaged in engineering the economy. Part of the engineering is boosting home prices higher by being accommodative to Wall Street, and therefore the growth of home prices exceeded the growth of wages, making housing less and less affordable every single year. When Powell says that inflation will be transitory, meaning that the pace of increase will stop at some point, does that help us at all? Of course not. Here's an example. Suppose my base salary is $70,000, which is a median salary in an urban city, average urban city in America. It is a mid-class wage, slightly in the upper mid-class range. And let's say the house that I'm eyeing to buy is worth about $800,000, or 11.4 times my wage. This is the base year, by the way. Now, fast forward to the transitory year of inflation, where wage growth spiked higher to 4%. Meanwhile, home price growth spiked to 12% year over year. So my wage went from $70,000 to $72,800. The home I'm planning to buy went up in value 12%, or $96,000, to a total of about $896,000. Now, the same home is worth 12.3% times my income. It went up higher from 11.4 to 12.3 times the wage I'm earning right now. Now, Powell says, not a problem. Don't worry about it. Inflation will be transitory. But by the way, prices are not going to go down. So let's see how helpful this transitory inflation is to us. Now, after the transitory year is over, and by the way, assuming that inflation will last for a year. Who knows? It could last for 2, 3. But sake of argument, let's say it lasts for a year, 2021, and that's it. And then we go back to normal. So my wages in the next year, after inflation is gone, according to Powell, my wage will grow by the average 2% year over year, meaning I'm now earning $74,256 a year. Meanwhile, the same home that I intend to buy went up in price 5%. This is the average year over year. Inflation is gone, remember? The home value went up by $44,800 to a total of $940,000, or 12.6 times my income. So my home affordability after this inflation experiment, the transitory inflation, remember? My home affordability went down because the house I wanted to buy was 11.4 times my income. Now, after the experiment is over, the same house will cost me 12.6 times my income. So I'm stuck with the inflation. I'm stuck with the increase in prices. I'm stuck with the so-called transitory inflation. And therefore, this whole narrative, this whole argument about transitory inflation, meaning prices will not go down, but the pace of increase will go down, is bullshit. It is nonsense at all. It means nothing for us consumers because we will be stuck with the higher prices. Our purchasing power will go down and our standard of living will go down. Now, back to Powell and the definitions regarding inflation and tapering. What does tapering mean, by the way? Does it mean cutting MBS purchases, mortgage-backed securities assets purchasing? Or does it include bond purchases? Remember, the Fed spends over $120 billion every single month, a minimum of $120 billion a month in buying MBS assets and bonds. And this is what created the TINA environment in the stock market. There is no alternative. If the Fed buys $120 billion a month worth of bonds or mortgage-backed securities, then we are left with no alternative to invest our cash in besides stocks. And therefore, this operation, which I call the cocaine operation, that has been going on for over 10 years since the 2008 financial crisis, the so-called emergency accommodations to Wall Street and the stock market. So that makes the stock market being artificially propped up higher by so-called emergency accommodation measures by the Fed for over a decade. And therefore, we had the biggest bull market in history. The easiest market in history. You pull a ticker out of a hat, you invest your money in that ticker, and you have 99.9% chance of making money. It has been a casino where nobody loses. Wall Street enjoyed it for over a decade, and now retail traders and investors joined to enjoy the last part of this mania, this hyper bubble. And the big question is, what happens when the Fed finally has to remove the so-called accommodative policy? The answer is the entire charade, the entire facade, the entire Ponzi scheme market will go down crashing like you have never seen before. But the argument always was, why would the Fed even consider tightening the monetary policy? Why would it ever consider removing the accommodative measures for Wall Street and the stock market? Because we don't have any inflation that merits removing the so-called accommodative measures. But now we have inflation, and that changed the game. And the Fed is in a tough position now because we have the COVID-19 crisis on top of all of that. Do you taper the cocaine operation to control inflation, to curb inflation, but at the same time causing the market and the economy to suffer a withdrawal because specifically the stock market has been a coke addict for over 10 years now? Or do you hold on tapering and tightening the monetary policy and pray that inflation will be transitory and it will just pass, and keeping the stock market propped up artificially via cocaine from the Fed? There is an argument for both, by the way. But before we do that, let's go back to the definition of tapering. Does the Fed mean tapering MBS purchases first? And if that is the case, then it's not a big problem for the stock market. But if it means tapering bond purchases, then it is a problem for the stock market. And the reason is it defies the TINA argument that there is no alternative but the stock market. Let's hear from the man himself, the chairman of the Fed, Jerome Powell.
I think there really is little support for the idea of tapering MBS earlier than Treasuries. I think we will taper them at the same time. It seems likely based on where people are now.
Okay, so he says when we taper, we're going to taper both MBS purchases and bond purchases. Pay attention here. So far, market participants did not take the Fed seriously at all. Matter of fact, the Fed did not take inflation seriously at all. They continued to say it is going to be transitory. We're not thinking about tapering. And therefore, every single dip in the market was bought by market participants, institutionals, and retail alike. But if tapering actually happens, then it will create the ultimate historic bull trap where dip buyers will get caught with their pants down. It already happened in China, by the way, in the Chinese market in general. Dip buying ceased to be rewarding for investors in the Chinese market. In fact, buying the dip turns out to be catching a falling knife. And this is exactly what will happen in the US market if we are indeed heading into tightening the monetary policy, the so-called accommodative measures that have been going on for over a decade now. And that leaves us to the debate. Is the Fed serious about cutting their assets purchasing program starting in October, or is this just a bluff? The market for now assuming that this is a bluff. The moment the market realizes that this is not a bluff, we will see a flush down, aka a withdrawal syndrome, and perhaps we already saw that by the end of the day today. We heard from St. Louis Fed President Bullard, who has the habit of smoking hash and being accidentally honest, more honest than the Fed playbook, perhaps because he is not a voting member. But Mr. Bullard says the U.S. experienced large inflationary shock, which the Fed needs to take into account by calibrating the policy in 2022. He is talking about raising interest rates, by the way, so he is way ahead of Powell and the rest. He also wants tapering to be completed by the first quarter of 2022. So this is an extremely hawkish stand by Bullard. indicating that the Fed is not joking about tapering. And now we have calls that the market could get caught with a nasty crash, the likes that we have not seen since the famous crash in 1987. We will see a massive flush down that will catch everybody by surprise, but specifically the dip buyers. On top of that, after hours, we have another pulse of the sentiment in the market. It is not just the looming threat of tapering, but the sentiment in the market, specifically from retail investors, is becoming negative. Retail investors got slaughtered. They bought garbage stocks, Plug Power, etc. AMC. In the case of Plug Power, they lost money. In the case of AMC, they're stuck, and pretty soon they're going to start losing money too. Robinhood says the majority of their income and revenue came from options trading and cryptos, indicating that retail investors are not really interested in investing in this market. They're interested in gambling and trading this market. Here's the problem, by the way. Powell says, I will give you advance warning before we start tapering, so you can have time to plan ahead and exit the market before the tapering happens.
At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. We also reviewed some considerations around how our asset purchases might be adjusted, including their pace and composition, once economic conditions warrant a change. Participants expect that the economy will continue to move toward our standard of substantial further progress. In coming meetings, the committee will again assess the economy's progress toward our goals, and the timing of any change in the pace of our asset purchases will depend on the incoming data. As we've said, we will provide advance notice before making any changes to our purchases.
So DJ Powell says, I will give you advance warning to leave the dance floor. The party is over before it is too late. Now here's the problem. Giving an advance warning, whenever that is, let's say they come out and say we will taper in October. This is in the September meeting, by the way. They come out and say we're going to taper in October. The market will crash right away. And the reason is everybody's rushing to the exit door. There is only one exit door and a huge mass of people trying to exit at the same time. Now, you and I know that the Wall Streeters and the likes will get the advance warning way before us. The main question is, did we just get the advance warning? I told you on Monday, Steve Leisman on CNBC over and over and over and over again with the breaking news banner, reading the same statement that the Fed has reached a consensus, an agreement about tapering announcement in September. Do you think this was not done by design? Think again. Perhaps that was our advance warning. The question is, are we listening to the advance warning? So far not, because you see this behavior of buying the dip aggressively every single day. Every single dip is bought by institutions, retail, and algos alike. So why are we doing this behavior? Why are we not taking the Fed seriously? Why are we not taking tapering fears and warnings seriously? Perhaps this is why. This is from the FOMC minutes, by the way. In the post-meeting statement, the committee said the economy has made quote-unquote progress toward the dual goals of sustainable inflation around 2% and full and inclusive employment. Here's the most important part. The statement also noted that the quote-unquote substantial further progress, which Powell never bothered to define for us, benchmark had not been met yet. But markets took the statement to mean that the FOMC might start rolling back some of its policy accommodations soon. And therefore, we saw the flush down by the end of the day in the market. Is it a knee-jerk reaction? Who knows? But this piece, the substantial further progress being not met, is keeping the hope alive, keeping the dip buying alive. What else is keeping the dip buying and the bullish sentiment in the market alive? Here it is. In a handful of states, early data hint at a rise in breakthrough infections. Another headline from the New York Times. Delta surge drives home painful truth. COVID isn't going away. And we're seeing cases surging across the country. If COVID cases are surging, then COVID, in this case Delta, will change consumer behavior. The same behavior that has been fueling inflation for the last few months, meaning people will not go out and spend like they used to. They're not going to dine out, they're not going to fly, they're not going to book hotels and vacations, etc. And the reason? Fear of Delta. If that behavioral element alone, the adjustment in the behavior consumption element by the consumer, turns negative, then the assumption is demand will slow down in the economy, and therefore tampering inflation on its own. This is the assumption, of course, if we don't even discuss the supply dynamic of inflation, just concentrating on demand itself. Okay, so consumers will change their behavior, and their sentiment, by the way, according to the University of Michigan, went down significantly so. Then inflation will be tampered. Inflation expectations will be tampered, and inflation will ease in the next few weeks and next few months. This is the assumption. And if that is the case, then why does the Fed need to taper now? If inflation will ease on its own, this is the argument by the dip buyers and market bulls. And therefore, if you are a market bull, if you are a dip buyer, you should be cheering, Delta, Delta, Delta. Please kill more people so my stocks can go up. This is the only hope of delaying tapering. And therefore, once again, we have this debate, this tug of war between the dip buyers, market bulls who say that the Fed is bluffing, they're not going to be able to taper at all. And the reason is we have challenges from Delta and the change in consumer behavior. On the other hand, we have, shall we say, market bears who say inflation is growing out of control and the changes in consumer behavior and Delta cases, which we will revisit, by the way, in a second, is not that important because the supply dynamics are not being solved. And buying $120 billion minimum every month worth of assets will contribute to higher and higher inflation, risking a stagflationary dilemma in the economy. And therefore, we take the Fed at its word that tapering will be announced in September. And therefore, we're not going to buy the dip this time around. Matter of fact, we're going to start selling stocks and perhaps even shorting the market. And here is what happened after hours. The President of the United States, Joe Biden, in a televised speech, by the way, announced boosters. Roll your sleeves up. Boost them, baby. They're going to keep boosting them over and over and over again, forever and ever and ever. Why is this important, by the way, from an economics and market perspective? If the problem we're facing right now with Delta will be solved by another booster shot, a third booster shot, then we don't have a problem at all. We can have the booster shots next month, roll those sleeves, take the booster shot, no problem at all. We're done. And therefore, which camp is going to win? The dip buyers who are hanging their hats on Delta, or market bears who are saying the Fed will have to taper in September, at least announce the tapering? The answer is market bears will win. Dip buyers will get crushed. And by the way, we called this a long time ago regarding the vaccine efficacy. A year ago, I told you this and I showed you this clip. Even before the original vaccines were out in the market, these vaccines, the mRNA vaccines, have the so-called Snapchat effect. They're effective for a short amount of time, and then they start losing efficacy. And therefore, you're going to have booster shots over and over and over again.
Game in town that allows for even faster turnaround in developing and testing and then deploying vaccines, and it's called an RNA vaccine. RNA, which is a kind of ancient cousin of DNA. RNA molecules are the scripts that viruses use and that our human bodies also use to make proteins.
The coronavirus's RNA codes for at least 24 proteins, including its spike protein, which covers the exterior.
It's the protein that makes the coronaviruses have the crown appearance that they're named after.
SARS-CoV-2 uses this protein to bind to and enter our cells, where it then injects its RNA, hijacking those cells to make lots more virus.
It's almost like a skeleton key for a lock, opening a portal within human cells that the virus can slip in.
So if you can block that process, if you can neutralize the virus before it enters the cell, that will probably be the Achilles heel that we need to target.
We can tell our body, hey, if you see anything with that kind of a skeleton key shape, then just destroy it.
This is where an RNA vaccine comes in, which becomes possible when you have the virus's genetic sequence and you know which genes code for which proteins.
So the concept of an RNA vaccine is let's inject the RNA molecule that encodes for the spike protein.
It's making your cell do the work of creating this viral protein that is going to be recognized by your immune system and trigger the development of these antibodies.
Our bodies won't make a full-fledged infectious virus, they'll just make a little piece and then learn to recognize it and then get ready to destroy the virus if it then later comes and invades us.
The advantage of the RNA vaccine is that it can be produced within a matter of days. So these types of vaccines are much faster to generate.
Much faster than it takes, for example, to even prepare a flu shot for the seasonal flu strain. But on the other hand, it's a relatively new, unproven technology. And there's still no example of an RNA vaccine that's been deployed worldwide in the way that we need for the coronavirus.
There's the possibility for unforeseen adverse effects.
So this is all new territory. Whether it would elicit protective immune response against this virus is just unknown right now.
In addition, RNA molecules have a weakness.
Here's the dirty secret. They are ephemeral. They're like the Snapchat of molecules. Our bodies make an RNA script and destroy it a few minutes later once they've used it as a little temporary instruction manual to make proteins.
Okay, what else? In the wall of worry, we have China. Any updates on China? We have Chairman Xi saying that we have to curb on excessive income in China, encouraging the wealthy to give back. The risk from China continues to grow by the day. In the beginning, they started cracking on Chinese companies, specifically large Chinese companies with monopoly aspects in them. Now the Chinese states, the CCP, figured out that perhaps capitalism is not good in a communist country because it creates billionaires and powerful people who could challenge the CCP. And perhaps Chairman Xi and his CCP allies are looking at the model in the United States of America, the failing model of capitalism that has evolved from capitalism, an opportunity for all, to gangsterism, fueled by the monetary policy, creating the biggest wealth inequality gap in history, making the rich filthy rich, hundreds of billions of dollars in net worth. Meanwhile, we have homelessness all over the place, hunger in America, contributing to food and shelter insecurity. This insecurity will grow. At some point, you're going to have to cut the stimmies and the so-called aids, the enhanced benefits, they will go away and people will feel marginalized. We're going to have a class warfare in this country that could pave the way for political uncertainty, instability, perhaps even revolutions or civil wars. The Chinese are looking at the American model and they're saying perhaps we should go back to communism before the wealth inequality gap starts hurting the Chinese state. What's next? If China's cracking down on Chinese companies, if China's now cracking down on the rich in China, it is just a matter of time before the Chinese start cracking down on American companies. And this is the next shoe to drop in the wall of worry. Any update on Afghanistan? Not really, but it is a fluid situation and it is an extremely risky situation. The reason is we don't have any stability at all in the airport. Any mistake could happen. Any minute right now, somebody could get shot. God forbid somebody slips on a banana peel and they blame the other side and they start shooting at each other. And we have an American citizen that dies. Boom, we're back. We have to go back to war, start all over again. And here we go. We're back in Afghanistan forever and ever and ever. And with that, ladies and gentlemen, let's move on to the market performance today. And here we go. The Dow Industrial Average closing in the red, down by 382.59 points, or a decline of 1.8%. The Nasdaq closing in the red, down by 130.27 points, or a decline of 0.89%. The S&P 500 also closing in the red, down by 47.81 points, or a decline of 1.7%. What about the sector's performance today? Shame, we're not going to give any medals today. Pretty much every single sector of the market closed in the red, led by the inflationary sectors of the market, materials, energy, and defensives. What about the market internals? A little better than yesterday. The NYSE 36% advancing versus 62% declining. The Nasdaq 49% advancing versus 48% declining. We will see if this was a knee-jerk reaction at the end of the day, the last hour of the day, when the SPY, the Qs, the IWM across the board, even the Dow Jones, flushed down. The market internals remain negative, but they are improving. So yesterday we had a day with a massive rebound off the lows. Meanwhile, the internals, the advanced to decline ratio, was actually horrendous. Today we have a flush down at the end of the day. Meanwhile, the internals, the advanced to decline ratio, improved slightly. What about futures? What's going on here? Crude oil getting whacked today, whether it is the WTI or Brent, down by about 3% apiece. We also have declines across the board in metals, gold, silver, platinum, copper, palladium, all losing ground today. What about softs? Lumber is bouncing higher. The first bounce in 3-4 months? Lumber bouncing higher, and we see gains for sugar, coffee, and cocoa futures. Meanwhile, cotton futures on the flat line, while OJ futures suffered sizable declines of about 3%. What about meats? Gains across the board. Feeder cattle, live cattle futures, but specifically lean hogs futures, aka the new big tech, rebounding higher today. What about grains? Modest gains for corn, wheat, and rough rice futures. Meanwhile, losses led by oats, canola, soybean oil, soybean meal, and soybeans futures. Moving on to the big casino, the options market. What's going on here? The hottest table in the casino remains Apple, with about 1 million contracts traded today. About 77% of those were calls. The volume is deaccelerating, and when the volume deaccelerates in Apple, you're starting to see the impact of the pump and dump. They pumped the market on Monday and Tuesday via buying Apple calls. But again, I told you the sustainability of any market rally via gamma squeeze in Apple is unlikely because of the short-term mentality in these trades. They get in, they flip them fast, they make their gains, and they move on. At number 2, we have Pfizer with about 700,000 contracts. About 79% of those were calls. At number 3, PLTR, Palantir, with a little over 500,000 contracts. About 78% of those were calls. Palantir had decent earnings as of late, forcing some short covering and perhaps some buying from the retail side. This happens to be a retail name. They love the name for some reason. Who cares? But we also got the news that Palantir is hoarding gold bars. They bought about $50 million worth of gold bars to quote-unquote hedge against a black swan event. Do the executives of Palantir know something that we don't know? We'll see. But for now, we're moving on to the unusual activities that took place in the options market today. Starting with the ticker SPY for the S&P 500. They're buying protection here. The 412 puts, expiration date August 23rd, with expectations that the SPY could drop by over 6% by then. They paid about 30 cents apiece to enter this trade. All in all, spending about $600,000. What about the ticker ELAN for Elanco Animal? This is a pharmaceutical company that develops drugs for animals and pets. They're making a bearish bet here by buying the 29 puts, expiration date September 17th, with expectations that the name will drop by over 8% by then. They paid about 20 cents apiece to enter this trade. All in all, bringing the total to about $350,000. What about the trade for the ticker X US Steel? Lots of unusual activities for this name today. They're buying calls for some reason. Here's one of these trades. They bought the 32 calls, expiration date September 24th, with expectations that the name will rise by over 8% by then. They paid about $1.40 apiece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker GDS? This is for GDS Holdings. They're making a bearish bet here by buying the 40 puts, expiration date September 17th, with expectations that the name will crash by over 24% by then. They paid about $2.20 apiece to enter this trade. All in all, spending about $1.3 million. What about the trade for the ticker DKNG, DraftKings? In this case, they're making a bullish bet by buying the 55 calls, expiration date September 3rd, with expectations that the name will rise by over 6% by then. They paid about 90 cents apiece to enter this trade. All in all, spending about $500,000. What about the trade for the ticker DLTR for Dollar Tree? They're making another bullish bet here by buying the 108 calls, expiration date August 27th, with expectations that the name will rise higher by over 6% by then. They paid about $1 a piece to enter this trade, all in all spending about $500,000. Continuing with interesting trades. What about the trade for the ticker TSLA, Tesla? Bouncing higher today, perhaps AI day optimism, but somebody's betting the other way by buying the 630 puts, expiration date August 27th, with expectations that the name will drop by over 8.5% by then. They paid about $5 a piece to enter this trade, all in all spending about $2.5 million. What about the trade for the ticker INFO? This is for IHS Markit. This is the same company that produces the services and manufacturing surveys. The name got whacked today, and they're betting for more pain to come by buying the 110 puts, expiration date October 15th, with expectations that the name will drop by over 5% by then. They paid about $3.50 a piece to enter this trade. All in all, spending about $1.7 million. Lastly, what about the trade for the ticker IWM for the Russell 2000? They're making a bearish bet here by buying the 195 puts, expiration date September 24th. With the expectations that the name will drop by over 9% by then. They paid about $2 a piece to enter this trade. All in all, spending about $800,000. Moving on to the heat map analysis. What's going on here? It's a sea of red, losses across the board. But we have Tesla tilting things around and distorting the advance to decline ratio in the Nasdaq. Tesla surging higher by about 3.5% today. Again, it could be a lot of short covering. We saw a massive drop in Tesla in the last couple of days. And this could also be a bet for a surprise element, a surprise announcement in the AI day for Tesla. Could there be any surprise? We don't know. Once again, Reverend Elon Musk and his cult. He knows how to work them. The man is a marketing genius. No doubt about it. And he knows how to hype things up. What else in the heat map? We have certain names moving via earnings. For example, Lowe's gaining about 10% today. The name was down in empathy with the Home Depot yesterday, but today we're seeing lots of short covering, and the name managed to bounce higher by about 10%. We have a different story for Target, the ticker TGT, down about 3% for the day, even though the earnings were good in my opinion. But once again, the name is extremely overvalued, and therefore everything was already priced in. We have few Chinese names also moving higher, like JD and Pinduoduo, NIO, Xpeng, Li Auto, all moving higher. But besides that, we have severe underperformance in the market in general, specifically from Apple. This is the concerning part, by the way. As Apple goes, so will the market. And that leads us to the charts analysis, starting with the SPY 30 minutes chart. We were looking at this chart as a joke, by the way, a meme chart, specifically the last 2 days of trading. We saw a gap down on Monday and an insane bounce, closing at the highs of the day, at all-time highs. After a massive gap in the morning, aggressive dip buying. We opened the next day, gapping down once again, only to be met with the aggressiveness of dip buying, algos, institutional, retail, who knows? They're buying and pushing the market higher. Today, we had a similar story. The market opens gapping down, only to be met with the severity and aggressiveness of dip buyers rushing Naruto style, heads first, blindfolds on, asking questions later. Buy first, ask questions later. And the market managed to recover, closing the gap and trading at the highs of the day. Matter of fact, trading positive at some point of the day. And then we got the FOMC minutes, and the market whipsawed back and forth, back and forth. The initial reaction was to blast higher. And the reason is the Dixie went down big. The Dixie, the US dollar, flushed down. Why? Because we got the piece that I showed you earlier from the FOMC minutes saying that the quote-unquote substantial further progress, whatever the hell that means, haven't been met yet. Therefore, no tapering. So the Dixie goes down and the market goes higher because the market is a cocaine addict. No tapering means the cocaine will flow per usual. The market likes that. And then as the market decided to digest the information, the minutes are from a month ago in July, before the payroll report before the PPI, before the Empire Manufacturing Index, before the Consumer Sentiment Index, before the closure of ports in China, and if you factor all of that, perhaps tapering will be announced in September. Specifically, if we have booster shots, and we are heading to have another hot reading in the non-farm payroll report. Remember, the Fed says pay no attention at all to the CPI, PPI, core PCE, any inflation measure. That doesn't matter to us because we've been under the assumption from the get-go that inflation will be transitory. Pay attention to the employment numbers. Okay, so we got a hot payroll reading. Tomorrow, we have the per usual weekly jobless claims, and that number will be extremely important. If we have less claims, then we are making progress toward employment, which means tapering will happen, will be announced in September. Now, if the number comes out higher than expectations, meaning more people applying for unemployment benefits, then now we have a confirmation that Delta is causing a dent on the economy. So to answer the question, was today's reaction a knee-jerk reaction that will be corrected tomorrow? It depends on the jobless claims. Number one. Number two, what about the technicals? Severe damage here. We have violated the support of 443. We're back at the trading range, and we have 438 as the next support to eye. If that is violated, and if the consolidation box is violated, then boy, we're gonna be in massive trouble. And the reason is this will be the first time in this entire bull run since the March bottom of last year. It will be the first time when dip buying fails. Here's a chart of the SPY, a daily chart this time around. We have a gap at around 435.5. So I will be conservative here. Let's say the SPY opens in the morning flushing down, violating the support of 438 and even violating the consolidation box. The last line of defense will be 435.5. If that one is violated, then we're done. Daily chart of the continuous contract of the SPY. We are trading at the support of 4,384.5. If this one is violated, no problem. We have a trend line. The assumption is the SPY, in this case the futures, should be able to bounce from the trend line, catching support from the trend line. What if that support gets violated? Now you have another confirmation that the narrative in the market has changed and dip buying will fail. If you buy the dip, you will be catching a falling knife. The momentum indicators are now negative once again, both the MACD and the RSI indicators. The volume surged significantly higher on the down days, so we have confirmations all over the place of the weakness. Moving on to the Qs, the 30 minutes chart. What's going on here? We had a trading channel with defined peaks and defined valleys. That channel has been violated, and the Qs violated the support of 365.5. It went down all the way to 363, not quite, but bouncing higher. And I drew this yellow trend line, and I told you the threshold is if you go down for a third test of the trend line and the chart fails to bounce higher, then we have a confirmation of the reversal and the weakness. And indeed, this is exactly what happened today, violating the support line and violating 363 for support. So we have a confirmation of the weakness in the Qs. What about the daily chart for the continuous contract? The chart is now trading below 15,000, a critical level to keep. We have a confirmation of the negative momentum via a negative divergence in the RSI and MACD indicators. Furthermore, the volume is spiking on the down days, so we have more than one piece confirming that the Qs has indeed weakened and it is starting to flush down. To be conservative, we go on with the assumption that today's reaction was a knee-jerk reaction. We are awaiting a confirmation tomorrow. Perhaps the market needs to digest the information today, and perhaps it will come out with a different conclusion tomorrow. But the technicals don't lie. The technicals are negative now. Here's the IWM, your leading indicator, bouncing higher all the way to the resistance line of 218, only to fail from that level, getting rejected aggressively so. And now we have a confirmation of the weakness in the IWM. Now, where is the next support for the chart? The answer is 212. Moving on to the Dixie, the US dollar, whipsawing back and forth, up and down after the FOMC meeting. As the Dixie went down, that was the initial reaction, by the way. We saw the indices spiking up higher. But as the Dixie started to moderate and perhaps trending higher, we saw the indices reversing and trading to the downside. And the reason is, if there is tapering, then the confirmation will happen via the US dollar. Tapering means less cocaine in the market. This improves the value of the US dollar as less and less currency is circulated. Mind you, we have the reverse repo market reaching over 1 trillion once again, sucking cash out of the system, once again improving the value of the US dollar. Now, a higher US dollar is bad for gold and bad for stocks. Gold being the mature guy in the room once again. While we saw knee-jerk reactions in the dollar and stocks, the indices, the SPY, the Qs, the IWM, gold is trading flat. Why? The mature guy in the room is waiting for a confirmation. The action we saw today. Gold doesn't want to move up or down based on a knee-jerk reaction from the US dollar. But if we get a confirmation tomorrow and the dollar pops higher again, stocks go down, perhaps yields rise higher again. All of these are indicators that the market is starting to believe the Fed, that tapering will happen in October, perhaps announced as soon as September. And therefore gold, this is the assumption by the way, gold will go down as the dollar surges higher. And vice versa, of course. If today was a knee-jerk reaction and the dollar flushes down tomorrow, then gold will surge higher. And you have the levels right in front of you in the Fibonacci retracement levels. Support at 1,760, resistance at around 1,835. Here's a chart of the 10-year yield. Again, no confirmation at all, whipsawing back and forth, awaiting for more clarity. And again, even if we have clarity, even if we know 100% sure that the Fed will taper in September, the mechanical action of tapering, when the sugar daddy, in this case the Fed, who's been buying a quarter, if not more, of the entire supply of bonds, ceases to buy bonds, the assumption is bond prices will go down and therefore pushing yields higher. But there is a sentiment factor in this dynamic, which is if tapering happens, the pace of economic growth will slow down and therefore yields go down because bond yields, the yield curve in general, is an indicator, a reflection of the market sentiment regarding growth in the next few years. And here's the TLT bond prices weekly chart, not moving at all, hugging 149, waiting for more clarity. What would bond market investors want or do, looking at the tapering dynamic? If tapering happens or tapering doesn't happen. Again, we live in this bizarro world. Back in the day, if the Fed tapers, stops buying bonds, the assumption is bond yields go higher. But in this bizarre world, distorted by the cocaine operation, your assumptions have to be adjusted because traditionally speaking, for example, gold has been a hedge against inflation for years and years and years. Now, this time around, gold has been proven to be not a reliable hedge against inflation. Likewise, last time around we had inflation, yields went higher. This time around, yields go down. Went down. And the answer for all of that is the Fed's engineering of the market via quantitative easing has distorted asset valuations and how bond yields and precious metals react to inflation because we have tapering to add to the formula. Moving on to the VIX. Whoa, what happened here? 4 hours chart. Folks, once again, there is a reason why I'm using the 4 hours chart, by the way, because every single instance, every single one, in the MACD indicator, when we had a crossing creating green impressions in the histogram, we saw a pop of a minimum double digits in the VIX. I told you that the pop in the VIX is not over yet, and the reason is the MACD indicator was still moving higher, creating more and more impressions, green impressions in the histogram. And we were waiting for the third and final attempt for the VIX to break above 20. Now the challenge is for the VIX to close the week above 20. That will be the ultimate sealer that dip buyers will be buried alive. If the VIX closes above 20 for the week, it's over because it is a massive change in sentiment. Looking at the MACD indicator right now, does it look that the VIX has topped out and it's done moving higher? On the contrary, it looks like the VIX has a little more room to go here before topping out, which means more pain for the equities market. What about Apple? What's going on here? It was trading slightly above 150 for a while, and when we looked at the chart last night, I told you, from a technical perspective, it looks bullish. The assumption is Apple will trade above 150. But when you dig into the psychology and the mechanics of the market, Apple has been moving via a gamma squeeze in the stock market, which was engineered to manipulate the stock market in general, as Apple holds the largest weighting in the SPY and the triple Qs. If you pop Apple higher, you will succeed in propping up the stock market higher, aka rescuing the market. But I've been telling you that these gamma squeezes, the rallies based on gamma squeezes, are not sustainable because traders will do it for a while, and if they hint that the dip buying efforts are not being successful, they're going to close these calls, booking profits, flushing the name down, and when Apple goes down, so will the market. This chart is the key to the market. I'm now eyeing the 145 level of support. If this one is violated, then we have a confirmation of the weakness in the market and perhaps a massive reversal to happen. Tesla, what's going on here? A massive rebound higher. We talked about the importance of 657. If the chart closes below 657 for the day, then we have a confirmation for the weakness and another green light for bears to continue to hold onto their puts. However, if the chart rebounds from 657 trading higher, then you have a signal to cover your shorts, and perhaps you want to go long for a little while. And this is exactly what happened, and now Tesla is trading above 679 once again. Now the candlestick pattern remains bullish. It is a bull flag consolidation, which should result in Tesla going back all the way to 720, making an attempt this time around to break above 720. The challenge is, can Tesla remain the shining city on a hill amidst the darkness? If the market sells off Tesla, the assumption is Tesla will not be able to hold on its own. It will be caught in the flush down too. It defied the trend for the day, but the sustainability of continuing to defy the trend becomes extremely difficult. Moving on to BTC, tulips. What's going on here? Again, perhaps topping out here. We have the saucer topping formation in the RSI, and we have a negative crossing in the MACD indicator, signaling that the momentum is turning bearish. Not extremely so, which means we could go back all the way down to 42,000 and then bounce higher again. However, failing to bounce from 42,000 will be a massive bearish signal. Moving on to AMC. What's going on here? Continuing to outperform the market, but we are starting to see some weakness here as we head to the end of the week. Remember, we have options expiration. So whether this is a knee-jerk reaction in the market regarding the FOMC minutes or not, we are heading into the Friday options expiration, the monthly expiration, which means we're going to see volatile moves in stocks up or down. The number I'm eyeing here is 37 because it has the highest open interest, closer to the money. Meaning, if AMC trades above 37 tomorrow, we will see a scramble, a gamma squeeze by market makers to buy AMC all the way to 40. And as we get to 40, we also have a high number of open interest, meaning we could see a gamma squeeze all the way to Friday. They will try to close the name below 37 because closing the name below 37 tomorrow will take the gamma squeeze off the table. So they will try to push the name down below 37, the market makers. If they fail and the name closes above 37, then we're going to see a gamma squeeze on Friday. This is the assumption. I cannot guarantee anything here. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We talked about the initial jobless claims. This will be even more important than usual. And the reason is, will it be the last bit of hope for the dip buyer crowd? And the reason is, if we get a hot number above 400,000, perhaps closer to 500,000, then we're going to start to cast doubt on the tapering prospects in September and October. But if the number comes out below 400,000 once again, then the dip buyers will have less and less to hang their hats on, as tapering appears to be likely to be announced in September. What else? We have the Philly Manufacturing Index. We are eyeing the headline number versus the prices paid number. The trend so far, at least from the Empire Manufacturing Index, the headline number is down, but prices paid and prices received specifically reached all-time highs. What does that mean? When economic activities go down, but prices continue to surge higher, it is a stagflationary phenomenon. Will it be confirmed by the Philly Manufacturing Index, or will it be negated if prices paid and prices received go down, along with the economic activities, the headline number? Anyhow, this is what I'm watching for in tomorrow's activities, but for now, this is all I got for you, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.